In a single day, the American stock market lost nearly a quarter of its entire value. There was no war. No bank had collapsed. No terrible economic report had come out. And yet, in a matter of hours, around $500 billion simply vanished into thin air. It was the worst single day in the history of Wall Street, and it terrified the entire financial world. This is the story of Black Monday, 1987, and how the machines nearly broke the market. To understand the crash, you first have to understand the party that came before it. The 1980s were a time of booming optimism on Wall Street. From 1982 onward, the stock market went on an incredible run, more than tripling in value in just 5 years. It was the era of big money, power suits, and the famous phrase, "Greed is good." Fortunes were being made. Confidence was sky high. And as always, that soaring confidence was quietly setting the stage for disaster. The boom of the 1980s was fueled by a frenzy of borrowed money. It was the age of the leveraged buyout, where corporate raiders used enormous piles of debt, often raised through risky junk bonds, to swallow entire companies. Merger mania gripped Wall Street. Deals grew bigger and bolder, and the money seemed endless. This flood of debt and speculation pumped the market higher and higher, rewarding aggression and punishing caution. By 1987, the whole system was running dangerously hot, and many sober observers were deeply worried. Stock prices had climbed far faster than company profits could possibly justify. By almost every historical measure, the market looked wildly expensive. But in the middle of a euphoric boom, warnings like that feel like background noise. The bulls were winning, the money was flowing, and questioning the party felt foolish. Beneath the glittering surface, the market had quietly become a coiled spring, wound tighter and tighter, just waiting for a trigger. But something fundamental had changed about how the market worked, and this is the key to the whole story. For the first time, computers had taken over a huge part of trading. Instead of humans making every decision, powerful programs could now automatically buy and sell enormous bundles of stocks in seconds, based on preset rules. This was called program trading. It made markets faster and more efficient. It also introduced a brand new kind of danger that almost nobody fully understood. At the heart of that danger was a clever financial invention called portfolio insurance. The idea sounded brilliant and safe. It was a computer strategy designed to protect big investors from losses. The rule was simple. If the market started falling, the program would automatically sell stocks to limit the damage. If the market kept falling, it would sell even more. In theory, it was an automatic safety net. In reality, it was a hidden time bomb wired into the entire market. Here's why portfolio insurance was so dangerous, and it's the crucial concept to grasp. Imagine a crowded theater where everyone has installed an automatic system that rushes them to the exit the instant they see anyone else move toward it. One person heads for the door, which triggers others, which triggers others. In seconds, you have a stampede. Portfolio insurance did exactly this to the stock market. It programmed thousands of investors to all sell at the same moment, feeding a panic instead of preventing one. By the fall of 1987, cracks were already forming beneath the boom. Interest rates were rising, making bonds more attractive than risky stocks. Many analysts felt the market had simply climbed too high, too fast, and was wildly overvalued. Tension was building, and in the days right before Black Monday, the market had already started to slide, falling several days in a row. The mood on Wall Street was turning nervous. The pressure was building toward a breaking point. That week, the selling accelerated. On the Wednesday, Thursday, and Friday before the crash, the market fell sharply, dropping around 10% over just those few days. Investors went home that Friday deeply anxious. The portfolio insurance programs were now primed to sell huge amounts of stock the moment trading reopened. Over the weekend, fear spread through phone calls and newsrooms. When Monday morning arrived, the market was sitting on a mountain of pending sell orders, ready to explode. Several specific sparks lit the fuse that weekend. The United States had just reported a worse-than-expected trade deficit, rattling confidence in the dollar. Interest rates were climbing. There was talk in Washington of a new tax that would cripple the corporate takeovers driving the boom. And rising military tension in the Persian Gulf added to the unease. No single one of these was catastrophic, but stacked on top of an overvalued, over-leveraged, machine-wired market. Together they were a lit match beside a barrel of gunpowder. Then came Monday, October 19th, 1987. From the very opening bell, it was a bloodbath. A tidal wave of sell orders crashed onto the market. Prices plunged immediately, and this triggered the Doomsday machine. As stocks fell, the portfolio insurance computers automatically dumped more stock. That extra selling pushed prices down further, which triggered even more automatic selling. The feedback loop had begun, and once it started, it was almost impossible to stop. It's worth seeing exactly how the loop fed itself, because it was diabolical. Selling stocks pushed the stock market down. That drove investors to sell stock index futures, a related market, to hedge their bets. The falling futures then made stocks look even more overpriced by comparison. So computer programs called index arbitrage sold yet more actual stock to profit from the gap, which pushed stocks down again, which triggered more future selling. Round and round, faster and faster, a self-reinforcing avalanche. The scenes on the trading floor were pure chaos. Traders screamed and waved as prices collapsed faster than they could react. The systems were completely overwhelmed. So many orders flooded in that the ticker tape fell hopelessly behind, showing prices from hours ago. Phones rang unanswered as brokers hid from panicked clients. Nobody knew the real price of anything. It felt less like a market and more like a machine spinning wildly out of human control. As the avalanche roared on, the market's basic plumbing began to fail. On the exchange floor, the human specialists whose job was to match buyers with sellers were buried under an impossible flood of sell orders and almost no buyers. Many well-known stocks simply couldn't open for trading or froze for long stretches. The system that everyone had always assumed would just work was cracking under the strain, piling confusion on top of an already collapsing market. Worse still, the stock market and the futures market in Chicago began to break apart from each other. Prices in the two markets, which normally move in lockstep, spun wildly out of sync because information simply couldn't keep up with the speed of the collapse. Nobody could tell what anything was truly worth anymore. And this breakdown fed the arbitrage computers even more chaos to trade on, pouring gasoline on the fire. The machines kept selling into a market that was barely functioning. When the closing bell finally rang, the damage was almost unbelievable. The Dow Jones Industrial Average had fallen 508 points, a staggering drop of 22.6% in one single day. To put that in perspective, it was far worse than the worst day of the 1929 crash that led to the Great Depression. Around $500 billion of wealth had evaporated in a matter of hours. It remains, to this day, the largest single-day percentage drop in Wall Street history. And it wasn't just America. The crash was global, and it spread with terrifying speed. Because markets are connected around the world, the panic raced across every time zone. Hong Kong crashed. Australia crashed. London crashed. The selling swept across Europe and Asia in a chain reaction. Some markets fell even harder than the United States. In a single day, the entire global financial system had been hit by a simultaneous, coordinated wave of fear. It felt like the whole thing might unravel. That night, one terrifying question hung over the world. Was this 1929 all over again? Would this crash trigger a chain of bank failures and plunge the globe into a second Great Depression? People remembered the breadlines, the ruin, the decade of misery. The fear was very real. The financial system stood on a knife's edge. What happened in the next 24 hours would determine whether Black Monday became a footnote or a catastrophe. And this is where the story turns. Enter Alan Greenspan. He had become the chairman of the Federal Reserve just 2 months earlier. Now, in his first major test, the entire financial system was threatening to collapse on his watch. Greenspan and the Fed understood something crucial, a lesson learned from the disaster of 1929. Back then, the Fed had done too little and let the banking system implode. Greenspan was determined not to repeat that mistake. This time, the response would be fast, and it would be overwhelming. The morning after the crash, the Federal Reserve issued a short, powerful statement. It affirmed that the Fed was ready to serve as a source of liquidity to support the economic and financial system. In plain English, don't panic, we will provide all the money needed to keep the system running. The Fed then flooded the banking system with cash and encouraged banks to keep lending. It was a masterclass in calming a panic. And astonishingly, it worked. But the danger was far from over. In fact, the day after the crash, Tuesday, October 20th, was in some ways even more terrifying. The financial system came within a whisker of total seizure. Major exchanges nearly shut down completely. Frightened banks grew reluctant to lend to the brokerage firms that desperately needed cash just to survive. For a few horrifying hours, it looked like the entire market machinery might simply grind to a halt and take the financial system down with it. This was the true moment of maximum danger. Behind the scenes, the Federal Reserve leaned hard on the major banks, pressing them to keep the credit flowing to Wall Street no matter what. Slowly, the money began to move. And then, in a dramatic turn on Tuesday afternoon, buyers suddenly surged back in, and the market staged a violent rebound. The immediate freefall was over. The system had survived its near-death experience, held together by fast action and raw nerves. The reassurance broke the spell of fear. Confidence slowly returned. Buyers, seeing bargains everywhere, began stepping back in. And then came the truly stunning part of this whole story. Unlike 1929, Black Monday did not lead to a depression. It didn't even cause a recession. The economy kept growing. And the stock market, which had lost nearly a quarter of its value in a day, recovered all of its losses within about 2 years. The catastrophe simply never came. This is one of the most important lessons in all of financial history. The 1987 crash and the 1929 crash looked similar on the surface, but they had opposite endings. Why? Because of the response. In 1929, the authorities let the system collapse. In 1987, they acted instantly and decisively to provide liquidity and confidence. The crash was the same kind of shock. But the wisdom to respond correctly turned a potential depression into a temporary scare. Policy made all the difference. In the aftermath, regulators worked to make sure a purely mechanical meltdown like this couldn't happen so easily again. They introduced what are called circuit breakers. These are automatic trading halts that kick in when a market falls too fast, pausing trading to give panicked humans a chance to breathe, think, and step back from the ledge. It was an admission of a new reality. In a world of computer trading, sometimes you have to force the machines to stop. Afterward, a presidential task force, known as the Brady Commission, dug into exactly what had happened. Its conclusion was sobering. It found that the crash had been massively amplified by program trading and portfolio insurance, and by the dangerous disconnect between the stock and futures markets. In other words, the machines and the financial engineering hadn't merely failed to prevent the crash. They had turned an ordinary decline into a historic collapse. It was an official warning about the risks of the new, automated age. Because that is the deepest meaning of Black Monday. It was the first great crash of the computer age. It revealed a chilling new danger, that the very tools designed to make markets safer and more efficient could, under the right conditions, turn on us and amplify a panic into a catastrophe at machine speed. It was a warning shot, a preview of a future where algorithms, not humans, could move markets faster than anyone could possibly control. And that warning came true. Decades later, we saw echoes of Black Monday in events like the 2010 flash crash, when high-speed trading algorithms briefly caused the market to plunge and recover within minutes. The specific technology keeps changing, getting faster and more complex. But the underlying lesson of 1987 remains permanent. When you automate fear, you can create a stampede at the speed of light. The machines only do what we program them to do, including panic. We saw that response lesson prove itself again in 2020. When the pandemic triggered the fastest market crash in history, the Federal Reserve remembered Black Monday and 2008. It responded with overwhelming force almost instantly, flooding the system with liquidity and support. And once again, a terrifying crash was followed by a remarkably fast recovery. Across the decades, the pattern holds. It is not the shock alone that decides the outcome, but the speed and courage of the response to it. So let's pull out the timeless money lessons, because they protect you directly. Lesson 1. The tools meant to protect you can become the source of danger. Portfolio insurance was designed to limit losses, yet it caused the crash. Whenever everyone relies on the same automatic safety strategy, that strategy itself becomes a systemic risk. Be very cautious of any protection that only works if everyone else isn't using it at the exact same time as you. Lesson 2. Panic is the real destroyer, not the price drop itself. The market fell 22% in a day, but investors who simply held on, who did not sell in terror, got all their money back within about 2 years. The people who were truly ruined were the ones who panic sold at the very bottom, locking in their losses forever. In a crash, your emotions are far more dangerous to your wealth than the crash itself. Lesson 3. The stock market is not the economy. This is one of the most misunderstood truths in finance. In 1987, the market had a heart attack, yet the real economy of jobs, factories, and businesses barely flinched and kept right on growing. A falling market does not automatically mean the country is doomed. Sometimes it's just fear and machines, disconnected from the real world. Learn to tell the difference between a market panic and a genuine economic crisis. Lesson 4. Decisive action in a crisis can change everything. The single biggest reason 1987 didn't become another Great Depression was the swift, confident response of the Federal Reserve. It proved that a crisis is not just about the initial shock, but about how you react to it. This applies to your own finances too. When something goes wrong, the panicked, frozen response often does far more damage than the original problem. Calm, decisive action is a superpower. Lesson 5. Understand the systems your money lives in. Most investors in 1987 had no idea that computer programs were quietly wiring the entire market to stampede. The people who understood the machinery saw the risk that others couldn't. In today's world of algorithms, high-frequency trading, and complex products, that need is greater than ever. You don't have to be an expert, but understanding the basic forces moving your money is one of the best protections you can have. Looking back, Black Monday is a strange and fascinating crisis. It was one of the most violent crashes in history, and yet it left almost no lasting economic damage. That paradox is precisely what makes it so valuable to study. It shows us how fragile markets can be, how quickly fear can spread, how technology can amplify panic, and how the right response can pull us back from the edge of disaster. It was a dress rehearsal for the modern financial age, and its warning grows more relevant every single year. Today, an even larger share of trading is done by machines, at speeds no human can follow. The markets are more automated, more interconnected, and more complex than ever before. The next Black Monday, if it comes, could unfold in minutes instead of a day. Understanding what happened in 1987 isn't just history. It's a guide to the very real risks hidden inside the modern market that holds your future. So the next time you see the market plunge and the headlines scream about a crash, remember Black Monday. Remember that the biggest one-day drop in history was followed not by ruin, but by recovery. Remember that panic is more dangerous than the fall, that the market is not the economy, and that the machines are only as wise as the humans who build them. Keep your head when everyone else is losing theirs. That is how fortunes are protected and made. If this breakdown helped you understand the market a little better, then this channel is exactly for you. We tell the biggest money stories in history, the crashes, the bubbles, the frauds, and the comebacks, and pull out the lessons that keep your own money safe. Subscribe to Money Stories, ring the bell, and tell me in the comments, do you think a machine-driven crash like Black Monday could happen again? See you in the next one.